Welcome everybody. My name is Jeff Fowler, President of the Apartment Owners Association, and it is great to have you with us today. We're looking at how to unlock passive income through a Delaware statutory trust. So we're going to be covering that today. And we all thought when we got into it that, owning rental property was passive income, but I think we all know by now that that's absolutely not the case. There's so much that you have to know. There's so many different things to comply with. There's working with the tenants, keeping that property up. There's so much, so much that's involved. And AOA is here for you. And we've been around for over 40 years and just so blessed to have the largest individually organized groups of apartment owners in the state here. And man, we're just so thankful. And it's such a pleasure to be able to work and help people do their job better. And in any way, so yeah, so thankful. Really, our goal is to keep you in the know so that you can be one of the most successful rental property owners in the state, and because that's our goal. And anyway, there's a lot of different things, a lot of ways that we can keep you in the know. And one of them is this SB 567 that has passed, and it is on Governor Newsom's desk. You can give him a call and tell him you oppose it. But the way that I understand it, it definitely impacts owner move-ins and who's allowed to move in. And specifically, if he signs that and it goes into law, then if the tenant is disabled, then you're going to have a tough time taking possession of that unit. And also one of the other key features with that, this is a California state law, and the other key feature is just restrictions around the substantial remodel, evicting for a substantial remodel. And so these are two really key points. And then from what I understand, still have to double check a little bit here, but it looks like that this also is impacting people who own, it's not just multifamily, it's really, it's impacting everybody that owns rental property. And I just need to confirm a few things because there were different changes that were made, but those are things that, so this one, 567, is kind of a big deal. And for people that have property in the city of LA specifically, and you have renters who have not paid rent and they have a legitimate COVID hardship and they're 80% of area median income, well, the Emergency Renters Assistance Program is opened back up again, and it's been funded with the ULM money. And I don't know why they called it ULM, that the mansion tax, but really it's an apartment tax, because there's very few properties in the city that are over $5 million, except for those that are rental properties. And again, stupid policies that make housing more expensive instead of more affordable. And anyway, so at least that those funds are available. I wish that all of the ULM fund could be, or ULA could be used for helping people if it's going to be used for anything. But unfortunately, so much of it is going to administration, attorneys, and just falling through the cracks and not being used well. All right, and then we have a few live streams that we've done here recently that also were to help you stay in the know. And one of them was a cash flow seminar that we did about ADU development opportunities. And so Mr. ADU shared, and you can catch that if you go to the YouTube channel that we have, AOA USA, and you'll see that one. And then Michael Brennan, he covered there's just new requirements for notices and things in Buena Park. And so just the tenant protections have increased there. There's some things that you really need to know. It's a little tricky, so definitely tune into that if you have property in Buena Park. All right, and then one of the other ones that we did with the president of the Howard Jarvis Taxpayers Association, John Kupal, we covered ACA 13, That's not to be confused with Prop 13, but ACA 13, totally different. Tune it, go ahead and watch that one for sure, because this is one that you're going to want to oppose. And the other one that is the one that's going to be on the ballot is Justice for Renters, and that just doesn't have a number on it yet. But when it does, then we'll talk more about it. But the Justice for Renters is another one that they, you saw people out at Walmarts and the Trader Joe's and getting signatures, and so they're putting that on the ballot, and to specifically repeal the Costa-Hawkins. So anyway, so lots of different things that are going on, and we're trying to keep you updated. It is a busy cycle right now. And anyway, so next week I believe that we're going to have Dennis Block speaking, and on the 26th in Santa Clara, there's going to be a maintenance of rental units and landlord inspection rights seminar that will be in person. And we did have one just this week in Oakland. So on Tuesday, it was great to connect with some of you guys in the Oakland area. So that was great. And yeah, there's just a lot of news, right? So much going on. And then we have the trade show coming up on October 19th. Definitely, you'll want to go to that. If you're in Orange County, LA County, surrounding area, you're going to want to come on out for sure. We're going to have over 20 seminars, and there's just so much that you'll be able to learn. There'll be over 150 booths, and I know I've been getting a lot of calls lately about insurance, being able to get covered, and so we will. One of the first seminars of the day is going to be a panel of insurance agents, and they're going to be talking about that specifically. And there's so many more. There's so many others as well that will be really useful for you, but that's just one that I wanted to mention. All right, and so here we go. If you are watching this and you are not a member and you never have been, there's definitely a 6-month free membership for you. So definitely you have to go. It's in person, so you have to go to get that. If you just register online and you don't go, you don't get the 6-month free membership, unfortunately. So we want to see your pretty face. And also, if you do go, please stop by and say hi. We're not just someone out there on a YouTube channel, but we're live people and that are eager to meet you. And many of you're calling in and getting help and understanding what you can do in your situation. So anyways, we appreciate all the interaction that we have with you. So big thanks for Real Estate Transition Solutions for sponsoring this time. And they are a real estate advisory firm. They're DST experts. They have 3 offices on the West Coast, and they do at least around 220 yearly in replacement properties. And I know that they've seen an uptick in business in this last quarter. And our speaker today is a partner at Real Estate Transition Solutions. He is in operations, marketing, education, and really very, very involved there. Been a part for the last 6.5 years, but really he's grown up in the real estate industry, his dad being a real estate investor. And he also has he's a CPA, and he worked with PricewaterhouseCoopers, so he has an extensive background there, and just really so suitable for the job that he has now, working with his father. And so it's my pleasure to introduce to you today Austin Bowlin.
Austin Bowlin. I'm a partner here at Real Estate Transition Solutions. And today we are going to be discussing Delaware statutory trusts, also commonly referred to as DSTs. And specifically, what we're going to focus on is just why DSTs have become such a popular 1031 exchange replacement property option, especially for those who are starting to grow tired of active management of investment real estate, but want to continue to have tax deferral and reap and realize all of the benefits associated with investment real estate, but doing so in a passive environment without any management responsibility. We have a fair amount of content ahead of us over the next 20 minutes or so, so I'm going to be moving fairly quickly through the slides. The Delaware statutory trusts that we'll be focusing on are unique in that they're both 1031 exchange eligible as what's referred to as like-kind property, but also treated as securities with the Securities and Exchange Commission. And as securities, specifically what's referred to as a Regulation D security, there is a requirement that in order to invest in Delaware statutory trusts, one must be what's considered an accredited investor. Now, for most, they are accredited by virtue of having a net worth in excess of $1 million, not including the value of their primary residence. But there are a couple other ways in which one can reach accreditation status as well: annual income threshold, or by holding a number of professional licenses or certifications. But do know that that is a requirement in order to exchange or invest into Delaware statutory trusts. A little bit of brief background on our firm, Real Estate Transition Solutions, or RETS. We are a real estate advisory firm that really focuses on serving property owners who are navigating what we consider to be the transition from the third to the fourth quarter of property ownership. And this is built off of a view of owning investment real estate where you could break it down into quarters. And it's not necessarily an even distribution of time amongst these quarters. You're more where you're at from an investment experience standpoint, and often how your goals and objectives change throughout those chapters of life. First quarter is often where individuals are purchasing their first properties, maybe making some mistakes along the way, but starting to solidify what their focus is going to be in their investment strategy. Second quarter is a period of time where often owners are adding value to their properties, physical improvements to the structure. Maybe it's cleaning up and improving the rent roll, the tenant profile at a property, but trying to create that value beyond just what the market is creating from an appreciation standpoint. The third quarter is what many people going into investment real estate can view as the promised land upon day one. And that's owning and operating what we would refer to as stabilized properties. Properties that don't require a lot of structural work or improvements, repairs and maintenance, that have good quality renters in the property, and should be about as efficient as possible from a management standpoint. But what I'm sure most of you who are joining us today are very familiar with is that even in that period of time, there's a significant amount of energy and effort that must go into either directly property managing that real estate or overseeing third-party property management. In addition, as the years go by, the properties themselves, the tenants themselves, the market conditions, certainly the regulatory environment, and the owner's objectives themselves are all changing, sometimes at a faster rate than we would like to see. So then it begs the question of, well, what is the ideal, most suitable replacement property option for that fourth quarter, where you're saying, I may want to reduce my overall risk profile. I want to generate stable, predictable income. I certainly do not want to pay any taxes. In a state like here in California, you could be looking at as much as 43.1% upon the sale of investment property. And fortunately, we have 1031 exchanges available to reposition investment real estate on a tax-deferred basis. And knowing that that tax can be deferred all the way up until you or your spouse pass away, and then it's eliminated. That's a concept that's referred to as a step-up in basis. Where the Delaware statutory trust comes into play is typically for people who are saying, I want to transition into that fourth quarter, and I want to reap all the benefits, but I want to do so from a passive standpoint. And the work that we do really consists of walking alongside property owners, educating them on what options they have available to them, dialoguing about what their unique specific objectives are, and then building transition plans for them and facilitating and executing that plan so that ultimately their investment real estate works for them and their objectives. The Delaware Statutory Trust is a very popular replacement property option for the property owner profile whom we serve. And our work on that front really consists of performing due diligence on the companies that present and provide these investments and manage the properties, what you'll hear referred to as DST sponsors, and each and every underlying property that we ever make available to clients whom we're working with as a 1031 exchange replacement property option. So the way in which our company is structured is we have a team of exchange advisors who are working directly with property owners. We have a team up here in our main office in Seattle, as well as down in Southern California in our Orange County office. We have a full in-house due diligence team. That's a unique way in which we're structured, where we've invested heavily into having the skill set and expertise to be able to underwrite and analyze both the operators, the companies, as well as the underlying real estate. We have our marketing and education team that produces all of the hopefully very helpful educational content that we make available through organizations such as AOA and on our website. And then also our client services, investor relations team to make sure any transaction that we're engaged in is a smooth, seamless process for the property owner. What we're going to be discussing today is first a little bit of foundational knowledge on the 1031 exchange itself. I want to make sure everyone at least has an introduction to that in case this is a new concept for you. I'm sure many of you are familiar with what 1031 exchanges are, so we'll be moving pretty quickly through that. We'll then focus on the DST. Why is it a popular replacement property option? What are the attributes, the benefits, the features associated with DSTs? And what are some of the moving parts? Who are the entities that are involved with DSTs? How is property analyzed? How does one go about selecting DST properties that might be a fit for their 1031 exchange? We'll talk about some of the other considerations that should be taken into account. There is no silver bullet replacement property option that's perfect for every profile out there and every set of objectives. We're very forthright and upfront about that. So what are some of the considerations that you need to be aware of if you're looking at DST properties as a 1031 exchange replacement property option? And then how does one go about identifying, selecting, and then ultimately exchanging into DSTs? We'll wrap up with an illustrative case study, and we'll talk through some additional educational resources available, and then hopefully have plenty of time for Q&A as well. So with that, the 1031 exchange, the transaction that's used for the vast majority of people who are investing into DSTs, is been referred to by many as the most advantageous section of the tax code. And with good reason, because what it allows is for an individual or an entity to sell investment real estate, property that's held for business or investment purposes, and instead of paying tax upon that sale, that would be tax on the appreciation, i.e. capital gain tax, the accumulated depreciation, what's referred to as depreciation recapture tax, both of which can be subject to net investment income tax at 3.8% Medicare tax and California state income tax. When you sum all those together, that's where we get to that 43.1% tax rate that can be applicable to a property sale. But instead of taking that haircut, you can reinvest all of the funds resulting from that property sale into new investment real estate, what's referred to as replacement property, provided that both the property being sold and the property that you are acquiring or properties are held for business or investment purposes. You'll hear this term like kind used regularly in association with 1031 exchanges, and it's very common for people to hear that and assume, if I'm selling a residential rental, I need to purchase a residential rental. Or if I'm selling an apartment building, I need to purchase an apartment building. But in reality, what the IRS means by like kind is the intent as to why that property is owned. And all property, regardless of property type, that's held for business or investment purposes is like kind with one another, including Delaware statutory trusts. So just what are Delaware statutory trusts? Well, the Delaware statutory trust is technically an ownership structure, similar in that an LLC or an S corp or a revocable trust, all different ownership structures. But what's unique about it is that it's an ownership structure that allows for an individual to exchange into owning a fractional interest, effectively percentage ownership of large institutional quality properties. Now, when I use the term institutional quality, what I mean by that are properties that are of the size and quality that you would typically see being acquired by the likes of a real estate investment trust, a REIT, a life insurance company, a university endowment, maybe a pension plan or a sovereign wealth fund. These are often individual properties or portfolios of real estate that would range in value from anywhere from, say, 50 million on the smaller end to as large as 200 million. Now, naturally, those properties are too large for most of us individuals to be able to acquire on our own. But by using the Delaware statutory trust structure, someone can sell, say, a single family rental for $1 million and then take a portion of those proceeds in exchange into owning a 1% interest of a 300 unit apartment building in Dallas, Texas, or an Amazon fulfillment center in Boise, Idaho, and create a diversified portfolio of multiple different DSTs. The DST property is managed by what's referred to as a DST sponsor. That's going to be an institutional real estate company who first acquired, then manages, then ultimately sells that real estate. Throughout the ownership period, which on average historically has been about 5 to 7 years, that property is income producing for the investors. Every investor receives their pro rata share of the income produced at the property level, typically distributed on a monthly basis, as well as depreciation for tax sheltering purposes, very key for all California residents. And then ultimately, when that property is sold, all of the sales proceeds, including any appreciation that the property realized, is then distributed back to the investors, who then get to make their own individual decisions as to whether or not they would like to continue to exchange or pay tax or any combination of. When I say continue to exchange, you have all the same options available to you at that point that you would upon the sale of a property today. So you could exchange into another DST, you could exchange back into the local market in a fee simple property that you own and manage yourself, or as I mentioned, you could also choose to pay tax. There's a, call it traditional general profile for whom we commonly see DSTs being a suitable investment for. What you see on this slide here paints that picture as to what that profile consists of. Now, not every one of these items is applicable to every single client whom we work with, but usually we see a fair amount of overlap between those who are electing to exchange into DSTs. What attributes do we commonly see? Well, typically it's someone who has a meaningful tax liability if they were to sell their property, warranting at least considering performing an exchange. Usually it's someone who at its core likes investment real estate as an asset class, as an investment, and wants to continue to have that in their portfolio. So maybe they built a healthy portion of their net worth by owning and managing investment real estate. They don't want to be actively managing real estate moving forward. And that includes direct property management and oversight of third-party property management, which still takes a considerable amount of time. They may want to diversify their asset base. It's very common for investment property owners to be concentrated in a single property type in a single geographic location. Say, apartment buildings or multifamily property within a commutable distance of your home. That concentration is a great way to build one's net worth, but when we start to look at market cycles, natural disasters, interest rates, regulatory environment, there is a certain level of concentration risk when that is how someone's portfolio is designed. And by being able to invest in different markets, different property types, different lease structures, et cetera, that can help to reduce one's overall risk profile. Commonly, the exchangers whom we're working with are looking for stable, predictable income, and often higher income than the properties that they're realizing today. They don't want that to be outright at the expense of appreciation potential. So there may need to be a growth component built into that portfolio. And they're also thinking about estate planning, whether that's something that's front of mind because it may be 5, 10 years out, or whether it's a little bit further back in their mind because it may be 20, 30, 40 years out. Investment real estate can be very difficult to transition to your beneficiaries, commonly your children, without forcing a co-ownership, co-management situation. But with the DSTs, it's very easy to divide ownership however your will dictates, distribute it down to your children. They receive that step up in basis, so there's no tax consequences. They could literally sell properties immediately following the second spouse passing and not pay any tax associated with that. But they're also not going to have to make co-ownership, co-management decisions as well. The benefits associated with DSTs are what you see identified here on this slide. So first and foremost, 1031 exchange eligible. So you can defer all of that tax that would otherwise be due. We commonly see DST properties outperform properties that our clients are selling from an income standpoint. And this is perhaps most apparent when we're looking at selling a single family rental. Just given the fact that the value associated with a single family is typically determined by someone who would be purchasing it as an owner occupant. So the relative cash flow to that value is commonly in the 2, sometimes 3% range. Whereas today, in today's environment, we're often seeing a blended, diversified portfolio of institutional DSTs with a starting cash flow in that, we'll call it low 5% range, with the expectation that that will grow year over year as well. DSTs require no management responsibility by the investors. All of that is taken care of by the DST sponsor from an asset management standpoint, and then either the sponsor's management company or third-party property management. That fractional ownership structure, owning a percentage of the property, is also what allows someone to diversify among multiple different DSTs. Even if they have a sale that may only be $500,000 or $600,000 of equity, they can still diversify across DSTs because the investment minimum for DSTs is fairly low, typically $100,000 of equity. That diversification ends up reducing one's overall risk profile. For those exchangers who need debt in their exchange, if you're familiar with 1031 exchange rules, you'll know there's a requirement to purchase equal or greater value in your replacement property. DSTs also present a way to do that because most DSTs, not all, but many, have leverage associated with them. Now, one thing that's worth knowing about DSTs is that while we work across all of the primary property types, each DST will almost always be property type specific. And each of these property types that you see listed here, and there are more that we work with beyond just those that are included on this particular slide, including student housing, hospitality, medical office, and the like. Each particular property type has its own unique attributes and will respond to market conditions in its own way. But they can be blended together based off of an owner's objectives, their overall portfolio, and really create a custom solution for that particular exchanger. Additionally, each DST is almost always going to be property type specific. So that really empowers the exchanger to say, you know what, I'm comfortable with multifamily. I maybe want to sell a property, have $2 million of exchange proceeds, want diversification, but I want to focus exclusively on this property type. Others will say, I want to have some exposure to industrial and senior housing and self-storage as well as multifamily. That's a conversation we get to have with you to talk about what are your preferences, what are your objectives, and then what blend of solutions is going to be most appropriate for you. Now, as I mentioned, no replacement property option is a silver bullet. And there are some considerations that one should know about before exchanging into DSTs. First and foremost is the fact that DSTs are an inherently illiquid investment. And what I mean by that is, while there is a mechanism to sell your ownership early before the underlying DST property is actually sold, mentally, you should go in planning to hold that property until ultimately it is sold and sales proceeds are distributed back to the investors. Now, historically, that's been a 5 to 7 year period. We do not know explicitly the date in which a property will be sold, nor would you want to invest in real estate where they say, with no consideration of market conditions, we're going to sell this property on year 5 or in year 5. The sponsor needs the ability to navigate the market conditions, execute their investment strategy in a fairly large window of time to sell the property. But typically we know what the maximum hold period is, and then historically we know most properties held 5 to 7 years. The maximum hold period is going to be dictated by the financing on the property, if that's applicable. So if a property does have a loan associated with it, traditionally we see 10-year fixed rate financing used. And that really establishes the maximum hold because the DST is legally not allowed to refinance itself in the trust. And then, of course, there are structuring costs associated with DSTs, and we'd always be happy to have a conversation to walk through those costs. But there's a significant amount of work that goes into identifying, evaluating, acquiring, structuring the property in trust to make available to investors, as well as managing that on behalf of the investors and ultimately selling it. The role that the DST sponsor plays in the process is going to consist of acquiring the underlying real estate, using their own balance sheet, structuring the trust around the property, and then managing that property on behalf of the investors. When an investor exchanges into a DST, what they're doing is they're displacing the capital that the sponsor used to originally purchase the property, until eventually enough exchangers will have invested in the property that it's wholly owned by exchangers and the sponsors retain to manage the property. Now, that has a couple implications and benefits really for 1031 exchanges. First and foremost, it reduces almost all of the timing risk or timing pressure felt with the 45-day identification period and 180-day close period. It also creates a form of accountability with the DST sponsor where they're putting their own capital up first before there are any exchange investors in the property. And they better feel comfortable owning that property, because if no one decides to exchange in it, they do own 100% of the property at that point. Importantly, though, the DST sponsor will make all of the operating decisions for the property over the life of the DST, including when to sell that property. And candidly, they are the most equipped to make those decisions, but there's not a concept of voting or anything along those lines, nor can an individual, even vocal investor, steer the ship on behalf of the other investors. Why work with an exchange advisor? Well, our team of 1031 exchange advisors has experience working through literally thousands of 1031 exchanges, walking alongside property owners, dialoguing with them and educating them on the options they have available, what is and what is not allowable, determining alongside that property owner what their objectives are, financial objectives like income, appreciation, risk tolerance, as well as lifestyle objectives and estate planning objectives. And then presenting replacement property options that are going to ultimately move that property owner from where they are today to where they want to be. We also work hand in hand with the exchanger, the client's other advisors, your CPA, your broker, your qualified intermediary, your financial advisor, your estate planning attorney, to make sure that the transaction is truly looked at holistically. So there's a lot of value that's created throughout that process in making a smooth and seamless transaction and transition that's going to move you closer toward accomplishing your goals. How does one go about identifying and ultimately acquiring DST replacement properties? You can visit online marketplaces and work through lists and perform your own underlying due diligence on the DSTs. That is an option. Ultimately, it will have to transact through someone who carries securities licenses. But you might as well work with an exchange advisor who's really going to learn and understand your objectives and then leverage hopefully a very robust due diligence process. I can speak to ours knowing that that is a very comprehensive process that all DST sponsors and properties go through, and then have recommendations specific to you presented and ultimately executed in the course of the exchange. Well, with all that information, I'm going to move over to a quick illustrative case study. What we have here is a couple in Southern California, San Diego specifically, who owned a 10-unit apartment building that had been purchased in 1987. They paid $850,000 for the property originally. The property was fully depreciated, meaning from that point forward, every dollar of income they were receiving was taxable, and they did not have a loan on the property. The couple also managed the properties themselves. We worked with them to understand what their objectives were. A broker was working on a valuation of the property, and ultimately it was concluded the property was valued at $350,000, and the tax liability that they would have had if they were to sell the property outright and not perform an exchange would be north of $1.1 million. You can see the breakdown of that tax liability here. And if you're interested in plugging in your own figures, we have a tax liability calculator available on our website that anyone can put their specific inputs, purchase price, improvements, year the property was acquired, state the property is located in, to get an approximate tax liability. But that's a meaningful haircut that would come out of the sales proceeds. Selling a property for $3.5 million and taking over a $1.1 million haircut for taxes. So they said, we want to perform an exchange, or at least consider and evaluate what sort of options we would have. Ultimately, what we landed on as the best fit for Walter and Maria was a diversified portfolio of DSTs. So they had an allocation to multifamily, the property type they were most familiar and comfortable with, also has historically had some of the greater appreciation potential. So 50% of their portfolio included multifamily, 30% to corporate guaranteed net lease retail, a very stable, predictable income stream, and then 20% to a single tenant industrial property, which was an Amazon fulfillment center in Boise, Idaho. Ultimately, what that translated to was a meaningful increase in the income that they were earning, while simultaneously decreasing the taxable income that they had because they added new depreciable basis, which is exactly the direction we like to see those figures moving. As far as additional educational resources go, we have our guide to upgrading your California exchange available on our website. And the best place for AOA members to visit is going to be our AOA member hub. What this is really taking kind of the best content from our website that's applicable to California property owners and distilling it down into one place. So that's re-transition.com/AOA. We also have our guide to investing in DSTs available on the website as well. And then webinars are a near weekly occurrence here at Real Estate Transition Solutions. Some of the upcoming webinars that you can see that we'd love to have you join for are estate planning benefits associated with DSTs. So we're going to really focus on that topic of transitioning assets to beneficiaries in a seamless and tax efficient way. And then also an overview of our internal due diligence process. What are the steps? Why is it important? And how do we go about vetting and analyzing DST properties? Perhaps the best option and opportunity for folks, though, is going to be to schedule a consultation with one of our exchange advisors. Now, this is something that we offer on a complimentary basis to AOA members. It can be a 15 or 30-minute phone call, Zoom meeting, in-person meeting, but we'd love to have an opportunity to answer any questions that you might have or speak about the specifics of your situation. And for those of you who are interested in seeing illustrative DST properties, you can visit our website and anyone can see closed properties that are no longer available for exchanging into, or request access to see currently available properties as well. But that'll give you a feel for the size and caliber and quality of properties that are making it through our internal due diligence process. And one last time, for those of you who may have missed it, that's re-transition.com/AOA. So that's all I have on my end, Jeff. I'm going to hand it back over to you in case there's any questions that came through. And if we want to pivot back to some of these frequently asked questions, we can certainly do that as well.
Great. Thank you, Austin.
You're
And if you could stop sharing there, we'll get your pretty face a little bit bigger.
Sure.
There we go. All right. So yeah, so if you guys have a question, now's the time to put that in the chat. If you're watching from the AOAUSA.com website, there's a blue help button, so you could put that in, and they'll get that question over to me. And of course, with YouTube and Facebook, you know what to do. And yeah, one of the questions that, and then also I just did want to make one other comment. One thing I failed to mention about that SB 567 is that the tenant protections would apply from day one. That was one of the other things about that thing that wasn't so hot at all. And again, you can go just send Gavin Newsom a email and let him know that you're opposed to that and everything. But anyway, yeah, to get into this, yeah, definitely put your question in. And one of the things that I hear that people don't really realize is, or how it works is, how are they able to get a 1031 and how are they able to exchange out of California?
So 1031, section 1031 of the tax code, that's federal tax code. So you can perform an exchange anywhere in the United States. Unfortunately, you can't exchange domestic real estate for international real estate or vice versa. But if you own investment real estate in California, there's really no restriction on where that property is located. You could, of course, purchase another property in California. You could purchase property in any other state. There's even actually a handful of territories in which you can acquire property in. Now, if you do elect to exchange out of California, which the vast majority of our California clients do, and that's a primary motivation for them to be selling their properties, they want to exchange out of California. When you do that, there is an annual disclosure form that you have to file with the Franchise Tax Board. It's a very short form, single page, really doesn't take any time at all, but it just states that property that I purchased in a different state that I acquired via an exchange and deferred the tax that I would otherwise pay, I've yet to sell that property and pay tax on it. You could sell it in exchange again, you'd be perfectly fine, but the important part is pay tax on it, because when you do, if you ever do, then California is going to try to claw back the tax that was attributed to the gain from California. Now, if your underlying strategy, like most of our clients, is to just keep exchanging until eventually they or their spouse pass away and all that tax is wiped away with the step up in basis, that's not an issue for you. It's just that form has to get filed every single year, but you will never pay that tax.
Great. And so what percentage are people, or what percentage can people expect to receive monthly? Like, what's the cash flow look like?
So this is going to be expressed based off of the equity invested. So let's walk through a quick example. Say someone sells a property for $1.8 million and they had $100,000 of transaction costs, title, escrow, brokerage, excise tax if applicable based off where the property is located. And then they had, call it 400,000 of a loan on the property. We'll say 500,000. Then what they're looking at is $1.2 million of equity resulting from the sale. And that equity is what is used to calculate the cash flow figure. So in today's environment, low to mid 5% range is what we're seeing for most diversified portfolios, where we may have a component of multifamily, industrial, senior housing, self-storage included within it. And so based off of 1.2 million invested, we'd be looking at somewhere north of, say, $110,000 of first year cash flow. And that doesn't capture appreciation, but the appreciation is not realized until eventually that property is sold, like everyone's familiar with today.
And what's the time frame? How long is this money locked up for in
On
the
average,
property?
the life of a DST is 5 to 7 years.
Mhm.
It can be shorter than that. It'll never be shorter than 2 years, but it can be shorter if the market conditions support selling it early. And it can go as long as the term of the debt. So in most cases, that's 10 years. But 5 to 7 is typically the window. If we were to do kind of one standard deviation or so of DSTs, the vast majority fall historically in that 5 to 7 year window.
Got it. And in the chat we have Art, and he's asking for the example given, how much did they pay for your services, and are there ongoing fees?
Good question. So our compensation is derived just as if that client, the exchanger, was working with a commercial real estate broker to acquire a new property. And what I mean by that is we serve as buyer's representation. We earn a commission, but it's paid by the seller, who in this case would be the DST sponsor. And it's consistent with what you see for traditional commercial real estate brokerage commissions. But when someone sells their property, they're usually paying the buyer's representation and their own representation. The same stands for the DST. The DST sponsor is now the seller, and they don't pay for their own representation. They just don't have it. They don't need it, but they do pay for buyer's representation. So it's really not an out-of-pocket expense for the exchanger, for the investor. But that's one-time compensation. We're not compensated on an ongoing basis from a management standpoint, although our relationship does not end there. I mean, we are still very much the client's primary point of contact as it relates to any sort of operating performance questions, any sort of administrative items like updating a mailing address or the account in which income is received into, year-end tax reporting questions, et cetera. So compensation is at the time of the transaction, but the relationship lives on well beyond that over the life of the DST.
And when this investment is cashed out on, basically, so again, it's going to be another 1031 exchange into another DST. And so for the next DST, is there another, at that point, is when you exit, is there a fee? And then in the next one, where's the fee come after just the initial?
Upon the sale of the property, the sponsor, they can't participate in the appreciation of the property. That's not legally allowed, but they can take a defined disposition fee. So usually the sponsor will have, say, a 2.5 or 3% disposition fee, which is a profit center of theirs and an important one from our standpoint. But we are not compensated at that point. The only time in which we would be compensated again is if that client, that investor, elects to perform another 1031 exchange into a new DST. Otherwise, if they decide to exchange back into the local market or pay tax, or maybe they or their spouse passed away and there's no tax consequences now and they just take the sales proceeds, then we're not compensated at that point.
I like that the sponsor company takes a percentage. I don't like that they take a percentage, but I like that it's a percentage as opposed to a flat rate, because then their motive to add value to that property is directly tied to what they're going to get when they sell it. So I think that's a great way to do that.
Completely agree. We're always looking for, in how a DST is structured, is it creating alignment from a financial incentive standpoint between the sponsor and the investors? And so that's something that is top of mind for us when evaluating DSTs. And the sponsors whom we work with that have made it successfully through our due diligence process, they do a great job with that. I mean, they say, hey, we're in this together. You're the investors, we're the managers. We would like nothing more than for you to be so pleased working with us that you exchange into our next property, which commonly occurs. And we're going to structure this in a way where, if you make more money, we make more money. If we make more money, you make more money. It's in many regards, I'm hesitant to use the term partnership because that would have adverse tax consequences for an exchange, but there's ways to try to get it to feel like that or behave like that without it being technically a partnership.
Right. Okay, Mona on YouTube. Do you have to be in an exchange in order to invest in a DST?
You do not. The majority of the capital that is invested in DSTs, last year we saw about $10 billion invested in DSTs, comes through 1031 exchanges. But we have had a number of clients who have cash invested in DSTs. They recognize the value of continuing to have tax deferral. They get some choice and some say and some control by being able to make new investment decisions every so often. And they don't want to be managing property. So that's happened a number of times. Typically, it's with a client who's already done an exchange with us, and they're saying, okay, now I'm familiar with this, and I have funds lying around that I'd also like to invest. The reality is, when you're cash investing too, though, you have a near limitless number of options available to you. You're not restricted by what the 1031 exchange can and cannot do. So there it's worth having a conversation around truly what are your objectives. If the DST is right for you, then that could be a great option to consider. But there are income funds, there are private REITs, public REITs, development projects. There's a near limitless number of options that we can also talk about for someone who's interested in cash investing.
Right. Okay. I just lost my train of thought because we have another question from Rick on Facebook coming in. And oh man. Anyway. Great. I'm glad we have this question. So here we go. I was going to ask a different one, but all right, Rick, I have an LLC. So let's say I go into escrow. Can I use my new LLC to go into multiple LLCs?
Okay, so probably not. I mean, the LLC in which the property was sold in really should be preserved through the exchange. And if that question is getting to, can you sell a property in an LLC and then say there are other LLCs that are out there that already own real estate, can that LLC acquire interests in those other LLCs? The answer to that's no. Legally, that's not allowed. The LLC could perform the exchange and it could go purchase another property, or it could invest in a DST, or it could invest in a tenant in common, but it can't exchange into owning a piece of a new LLC.
Right. And Rick, I know there's a little bit of a delay. So Rick, if that didn't answer your question, maybe rephrase it a little bit or add on a little bit so we get that one. And yeah, gosh, I was trying to remember. Oh, does it have to be $100,000 minimum investment on back to Mona's on that one if it's a cash investment? Does it need to be 100,000 or more?
Sponsors will take a smaller investment amount if it's coming by way of cash. Sometimes it was 25 or 50,000. Typically, we don't do that. That's too small of an investment for our firm to work with, unless this is kind of a let's dip our toe in the water precursor for, can I get comfortable with it, and do I want to perform an exchange down the road or make a larger investment? But those minimums are flexible, kind of case by case scenario. And I'd be happy to have a conversation, or one of our exchange advisors talk about Rona's specific scenario.
Right. And your phone number, your email address, everything is listed there. And guys, don't forget that there is that website that's specific. It's not up there, the one that's specific for AOA. I think it would be the re/transition.com/AOA probably, but there's a website up there, and we'll put that in the more section so that just to make sure that you guys have a link to that, because there's a lot there, and there's a lot of good resources for you. Mm-hmm. All right, on YouTube we have Florence. Who makes the decisions as to what properties are purchased for the DST? Great question. Here we go.
So technically, at first, the DST sponsor. So they'll be evaluating. Let's use an example that'll be familiar for most everyone. Let's talk about multifamily. If their focus is purchasing multifamily properties in the Southeast or in Texas, they'll be looking at dozens, if not hundreds of properties, and then ultimately writing offers on a few, placing them under contract, going through their due diligence process, deciding whether it meets their criteria or not, and then ultimately acquiring that property. Once they are typically non-refundable on their earnest money, which means they'll often still have 2 months before they actually close on the purchase, we will begin our due diligence process. We're not going to do it before that because, frankly, we don't know that they're going to buy the property at that point, and we want to be diligent and careful with our time and our resources. But once they're under contract, we'll start our process as they're receiving information, environmental report, engineering analysis, property condition report. They'll be sharing that with us, and we'll be going through our review and then doing some of our own independent analysis, predominantly on the market and projected financials as well. The last item that we receive, almost without exception, is going to be the final loan terms, because those are not available until actual closing day. And then we will decide, at that point, the sponsors purchase the property once they close. We'll typically take another week or so beyond that. And then we will decide whether or not that property meets our criteria and whether we are going to approve it. And then, if so, we have an abundance of information on that property that's shared with the advisors so that the advisors know what profiles are best suited for that particular property. And then ultimately that's what shapes and steers what's shared with investors as we're hearing their objectives. So what's interesting is when you look at who decides the properties, first the sponsor decides what they're going to buy. Then we decide what we're willing to approve. And then we decide what we are recommending. But at the end of the day, the investor decides what they're going to invest in. Mm-hmm. So 3 different tiers there, if you will.
Great, great. And Florence, again, is there a guarantee as to what the minimum return on your investment is paid?
No. And You'll never hear within the context of investment real estate there being a true guaranteed return. I mean, maybe something that's personally guaranteed, maybe something that's a lease, like an Amazon fulfillment center or Walgreens CVS that has a corporate guarantee on that lease. But big picture, guarantee and real estate really don't go together.
Right. So it's the same risks that you would take if you were investing in real estate directly yourself.
It shares many of the same risks.
Those plus maybe a couple. Yeah.
Plus the fact that you're not making the decision. So call it a level of control and management risk, which, one could easily also position by saying these sponsors have better process, have more information, they spend all their time doing this. They are probably better stewards and managers than any individual investor. I'm sure there's people on the webinar today that would refute that, but it's just the nature of an institutional process versus an individual investor. Then there's the fact that another different risk is, again, I imagine almost everyone who's joining today owns a single property type in a single market. So there's that concentration risk, and there's the risk of what happens to the properties if something happens to you. Is your spouse going to take them over? Your kid's going to take them over? Do they even know anything about the properties? Do they even know how to get into the operating bank accounts? There's all those risks too. None of that in the DST.
Great. Hey, we appreciate your time and your expertise every time. So really appreciate you.
Yep.
Hey, I'm going to see you in October 19th. You'll be at the trade show.
I'm actually not going to be there this year, but Roger, my partner in the business, and then another advisor on our team, our Orange County advisor, Brad Davidson, and actually one of the DST sponsors whom we work closely with is going to talk about that institutional approach to identifying multifamily properties. So it's going to be a fantastic presentation they deliver. I think they're at the 10:30 slot or so.
Okay.
But for anyone who's there, I'd encourage them to come by or visit the booth. Say hi.
Great. And for those of you that haven't been to the trade show, oh my goodness, you got to go. There'll be over 20 seminars, and there's two different types. We have the keynote speakers that are speaking for about 45 minutes. And then we also have the power talks which are 20-minute sessions. And there's just so many topics that are going to be covered, but that sounds like one that you'll want to definitely get in on.
Yep.
And so anyway, so thanks again. I'm glad we could do this before the show, just so that people know what you guys are going to be talking about. And of course, you'll have people at your booth all day long to take personal questions and specific questions and everything. So give these guys a call, and we'll put that link down in the more section so you can get more resources from their website. And anyway, thanks again, everyone, for joining, the good questions. And thanks again to you, Austin.
Thank you, Jeff. We'll talk soon.
Okay, bye-bye.